Our second speaker is Paul Gallagher, who has been writing about economics and financial policy for years. He's currently on the editorial board of the Executive Intelligence Review, and his topic today is the central bank's regime change and the Great Reset. Paul?
Thanks. I'll begin with a basic principle. Lyndon LaRouche taught, and he also greatly advanced, the American system of economy, which began with Alexander Hamilton's bold statement that the source of economic value is not landed property, not free trade, but human invention, the unique creativity of the individual human mind. The British imperial or free trade system is based on the idea that value or wealth come from trading, and national wealth comes from international trade. Ability to sell with greater advantage than you buy is only part of this wealth. Inseparable from this is wealth from speculation on trade, on currencies, on borrowing rates, on future prices, on success or failure in trading. Human creativity enters the economy most often through engineering new infrastructure platforms. This is where most true technological advances are first applied and show up as new kinds of capital goods. LaRouche frequently explained this. Franklin Roosevelt's presidency and the following period through John F. Kennedy's presidency demonstrated it in action. A prime example is the rapid advances in science and technology within missions for space exploration, which is, after all, the development of new infrastructure, transportation infrastructure for space travel, communications infrastructure in space, navigation infrastructure in and from space, power infrastructure for space exploration and colonization, etc. Therefore, it's important to understand that there was a fundamental change in the worldwide economy for the worse in 1971. Until 1971, Roosevelt's Bretton Woods monetary system created constant demand in the United States and European economies for more investment in capital goods and new infrastructure, skilled labor, and family farm production. It blocked international capital from speculating across borders. After the 1971 fatal decision by Nixon to break the US dollar from gold and the gold reserve, the floating currency system that replaced Bretton Woods incentivized and drove speculation and investment in speculation above all. In the half century since then, demand for new infrastructure and new capital goods gradually disappeared, giving way to demand for cheaper, larger scale production of existing goods. Cheap production exported into developing countries completely pushed aside Roosevelt's intention of capital goods exported into developing countries for great projects of infrastructure. Okay. The period of hyperinflationary pressure that we are now experiencing has been created not by pandemic and so-called recovery, but by decisions and actions of the major central banks under what they started calling their regime change in the fall of 2019. Here is the infamous inflation in Germany in 1922-3, known as the Weimar Hyperinflation. This is the Reichsmark against the US dollar in the right-hand column. From a few hundred to one to many trillions to one in that 18-month period. Household wealth, workers' earnings wiped out. The German central bank did this unintentionally but deliberately by printing money to try to hyperinflate away Germany's war debts and reparations payments. But you see at the bottom, at the end of 1923, a man named Hjalmar Schacht took over the central bank, the Reichsbank. Schacht used a large international loan organized by the House of Morgan to remove the foreign payments pressure. He used the introduction of a new currency, which Schacht made extremely scarce, to suddenly kill the inflation. As you see, just about 4 new marks called Rentenmarks to the dollar for the next 10 years. Schacht and the government used an extreme shortage of currency in imposing brutal economic austerity defeating all proposals to add any productive credit to the economy. Suffice to say that Germany's unemployment rate was 12% before the 1929 collapse. So hyperinflation is indeed transitory, as our current central bankers insist. They may wind up ending it abruptly with its opposite, deflation, with potentially murderous results. Germany was a special case. The general case then, in the 20s, in the United States and over most of Europe, was that after World War I, the regulation of commercial banks was dropped. Big commercial banks were allowed to take over investment banks and form stock speculation trusts, and bank holding companies were allowed to own investment banks as well as what we call today shadow banks of all kinds. They became what are called universal banks, offering, quote, one-stop banking. That term was used by Wall Street in the 20s as well as now. Especially in the United States, big Wall Street and Chicago banks formed speculative partnerships with smaller banks all over the country, selling them securities, which these small and middle-sized banks sold in turn to their customers. In the United States, Germany, Italy, France, Austria, the big universal banks became loaded with deposits, but cut back drastically on lending, which is also the case now. The Federal Reserve even made liquidity loans to the big banks and even bought securities from them, quantitative easing, in 1923-24 and in 1927. These banks brought on the stock crashes and bank bankruptcies of 1929 to 1933. The process is well and thoroughly described in a book published last year by Professor Arthur Wilmarth of George Washington University entitled Taming the Megabanks: Why We Need a New Glass-Steagall Act. That was the solution. In the United States, the commercial banks were reorganized with their speculative securities washed out and written off in Roosevelt's bank holiday in March 1933. That reorganization was made permanent by the Glass-Steagall Act 3 months later. That write-off was deflationary. It meant that new credit was necessary on a large scale. Roosevelt said in a press conference in April 1933, "You see, upon the closing of the banks, we put away somewhere around $4 billion. It was probably locked up before, but people did not know it. Now it is locked up and people do know it. That is deflationary." So he knew immediately upon reaming out these universal banks that the Tennessee Valley Authority and the Four Corners infrastructure projects were immediately needed. And the Reconstruction Finance Company, as a kind of national bank for production credit, immediately an essential part of Glass-Steagall. That was the actual solution then. Here is Lyndon LaRouche now, actually in 2010, after the crash, which he had tried to prevent by promoting the restored Glass-Steagall Act in Congress. And if we do that in the United States, if we put through a Glass-Steagall reform, this will wipe out trillions of dollars of worthless paper. But wiping out trillions of dollars of worthless paper and discontinuing the authority of certain kinds of banks, the speculative banks, would mean that we would be able to save the U.S. economy, at least within the United States. Then we have to create a new system of credit. And in creating a new system of credit, we have to go to a fixed exchange rate system among the nations which participate in the reform. By going to a fixed exchange rate system, we can maintain basic borrowing costs in regular loans of 1.5% or something like that as a base rate. We can then and must adopt a perspective of about 2 generations, about 50 years, of rebuilding the world economy. The emphasis in the beginning, because we've deployed so many industries and so much agriculture, the tendency will be to go to infrastructure program. Because we've destroyed so many industries and so much agriculture, the tendency will be to go to infrastructure programs, like mass transportation, for example, rail, maglev systems, improvements of water systems, as well as mass transportation, to a much expanded emphasis on nuclear power as a source of power, to improvements in municipal systems and so forth. The improvement in the area of basic economic infrastructure will create a demand for production from industry. That's the start of the solution now. The universal banks, which had caused the 1929-33 crash, banned by Glass-Steagall for half a century in the United States and much of Europe, came back with a vengeance from the late 1980s. After London's Big Bang deregulation of 1986, the regulators allowed universal banking everywhere. Today, it is banned only in China. The 2007-8 financial crash, as everyone knows, was based on this bubble of mortgage debt created by Wall Street and London universal banks and their pet mortgage companies. Households could not afford the soaring home expenses, so they borrowed them, thinking to make money in the process. Of course, this $10 trillion in debt, grown up by 2008, double what it was 5 years earlier, was only one small part of the worldwide debt bubble that crashed. On top of it was $10 trillion in mortgage-backed securities and perhaps $100 trillion in other derivatives bets. After this crash, the solution was rejected. LaRouche's Glass-Steagall solution, breaking up the universal bank holding companies and writing off their worthless securities, as well as banning home foreclosures while this was done, was rejected. Instead, the central banks began coordinated massive money printing to keep these universal banks liquid as their bets went bad and supposedly give them enough reserves to survive their next crash. The mortgage debt bubble was then replaced by an even larger global bubble of corporate debt. Some $13 trillion of corporate bond debt was issued from 2008 to 2018. That's the tall tan bar. That was more than in the previous 2 decades combined, the 2 gray bars. This is just one category. The total corporate debt bubble is now more than $80 trillion. In the United States, $12 trillion, doubled since 2010. And again, on top of that, debt securities and hundreds of trillions in interest rate swaps and other derivatives. Here are the claimed assets of the 4 biggest Wall Street universal banks combined. You see a big expansion during and after the 2008 crash they had caused, then slower but continuing growth to a monstrous size while being fed by the quantitative easing money printing of the Federal Reserve. Then there is the immense Wall Street asset management firm BlackRock, which is counted on by Prince Charles and the Great Reset oligarchs to force thousands of companies out of fossil fuels and out of carbonized industrial processes and into wind parks and solar farms. It was called, that is, BlackRock was called a giant that emerged from the crash under the Fed's quantitative easing. Its assets under management were $1 trillion in 2008, $6 trillion in 2017, and almost $9 trillion now. This was all only the prelude to what started in the autumn of 2019, when the central bankers themselves called what the central bankers themselves called the regime change, and which is about to blow out now. Go back to Mr. Hjalmar Schacht, the German central banker in the 1920s. After 1929, Mr. Schacht took a few years off to raise funds for Hitler from banker and industrial friends in Germany and London, and to campaign for the Nazis in 1932 and early 1933 elections. He found time to be in on founding the Bank for International Settlements in Basel, Switzerland, the so-called Central Bank for Central Banks. And he was quite a favorite with the Bank of England head, Montague Norman, and became a favorite with the British economist, John Maynard Keynes. In 1933, Schacht charged back in as Hitler's head of the Reichsbank and as Minister of Economics at the same time, with much more power than he'd had 10 years earlier. Back then, the deflationary Mr. Schacht had made currency very scarce. Now he printed money as no central banker ever had before. The Mefo bills he printed were his idea, not Hitler's or Goering's. He had a circle of the biggest banks and industrial arms producers form a dummy company, massively issue their own IOUs, and his Reichsbank bought them with new currency. By this plan, he took fiscal powers of the Nazi government, making the central bank dominant in what was supposedly government spending. That was a central bank regime change. More important was its purpose. That was a huge shift in economic activity across the board. As Jacques mentioned, in just 2 years, 33 to 35, Schacht drove arms production from 2% of Germany's GDP to 20% of it. Some other industries, for example, textile and clothing production, agricultural implements, housing construction, were throttled in the process. In the context of that shift began the labor camp system, which gradually evolved into the horror of the 20th century. There was the model. Lyndon LaRouche made a huge issue of it in the early 1970s when Roosevelt's Bretton Woods system was destroyed. LaRouche warned that what resulted would be Schachtian fascism. In August of 2019, central bankers met at the Federal Reserve's annual Jackson Hole, Wyoming conference and discussed a proposal by former central bank leaders from 4 countries, now all executives at BlackRock Incorporated, the world's biggest financial firm. They called it regime change. It was time, they said, for central banks to take control of spending powers from governments. The conference also discussed a presentation by Bank of England head Mark Carney, Mr. Zero Carbon among the central bankers, who said the central banks would have to create a synthetic world currency they controlled to replace the US dollar. The reason for both proposals: the central banks must finally succeed in their 10-year mission impossible after the 2008 crash to set off inflation. They must create huge amounts of consumer demand by printing money and directly helicoptering it out. The truth, of course, was that governments needed to create demand for capital goods, new technologies, and productive employment in the way that Lyndon LaRouche had laid out, by issuing credit for new great projects of infrastructure. But such investments had been dropped 50 years earlier when FDR's Bretton Woods system went down. So instead, the central banks arrogated to themselves vast consumer demand for goods and services by their own money printing. And primarily, of course, among the consumers, the wealthy consumers would do this consumption because their wealth would be greatly increased in the process through the stock market and similar means. In fact, whatever volume of currency these central banks were going to be printing was doomed to be largely absorbed into new financial speculations of the biggest Wall Street and London firms. But the regime change went ahead, beginning with the Federal Reserve's resumption of quantitative easing in early October 2019, followed by the European Central Bank. The excuse was the U.S. interbank lending crisis, the so-called repo crisis of September 2019. No pandemic was yet in sight to be blamed for this. Here is the scale of that late 2019 acceleration in transatlantic central bank liquidity and reserves printing through the universal banks. Up to now, I've been showing you graphs which ended in 2018 or 2019. That was to make clear the dramatic shift under the central bank's regime change policy, which can be clearly seen here, starting in the fourth quarter of 2019. Look at the effects on the biggest banks. This is JP Morgan Chase, the biggest Wall Street bank. Look at the increase in its size just from the fourth quarter of 2019 to the first quarter of 2020, an approximate $250 billion increase in deposits, an approximate $450 billion increase in assets in one quarter. And this has continued. JP Morgan's assets have now exploded by a full 30% in 1 year. But look at loans and leases. Effectively, there's no change across from the first quarter of 2019 through the first quarter of 2020. There is no change in loans and leases of those banks at the same time as their deposits and assets are exploding. Just as in the 1920s, the megabanks are getting monstrously bigger in deposits and assets, but they are not lending. The central banks have created huge undead universal banks, which essentially cannot fail because the central banks will not allow them to fail, no matter how much of their assets blow out, but they also cannot lend. This must be stopped. The Glass-Steagall reform, as FDR and LaRouche each understood it, is the weapon to stop it. And here are the assets of the Federal Reserve itself. It is, after all, a bank, which creates its own new assets against a very thin slice of capital by printing money. This slide, although recent, can't keep up. The Fed's asset book is over $8 trillion as of early this month. So it is 10 times its size of 2008. And again, look at the sudden shift and acceleration in late 2019, the start of the central bankers' regime change. The purpose of this regime change has become clearer since August 2019, especially with Mark Carney's new UN climate change ambassador role, while he still issues more and more central bankers' orders in public speeches. Companies must go zero carbon or die, he says. Investment in fossil fuels must stop. Developing countries must accept carbon credits as payment to stop their own development completely. Banks and big fund managers must enforce the total investment shift out of fossil fuels and into green technologies. Like Hjalmar Schacht, the central banks are using their money printing and regulating power together with the biggest transatlantic universal banks to drive a dramatic shift in economic activity. Their great shift is into what they intend to be a $30 to $40 trillion green finance bubble, which will get them through a global debt collapse, the so-called Great Reset. This must be stopped. Is it like the Weimar Hyperinflation or the verge of a deflationary collapse? Central banks have created both. What is critical is that it must be stopped. Glass-Steagall breakup of these banks in every nation and nationalization of central banks to create national credit institutions for productivity and productive employment is the way to do that.